Suppose two balance sheets are given to you, 31st March 2010, 31st March 2011. Assets, cash 5,000, 10,000. Debtors 5,000, 0. Furniture 10,000, 20,000. Total 20,000, 30,000 rupees. Capital 5,000, 15,000. 10% debentures 10,000, nil. Proposed dividend 5,000, 15,000. And you are supposed to prepare cash flow statement on the basis of these two balance sheets. One thing is clear, there are 10% debentures on the liability side. What it means? These balance sheets belong to joint stock company because no firm can issue debentures. So before I start the question, I should prepare some accounts. First of all, proposed dividend. So you know the format: by balance BD, to balance CD. To cash in the bracket, dividend paid. On credit side, by profit and loss account, dividend proposed. So by balance BD 5,000, to balance CD 15,000. Now the question is silent. How much dividend was paid during this year? So we'll assume that in the beginning the provision for dividend, I mean to say dividend proposed was rupees 5,000. The same amount has been paid to the shareholders. So to cash 5,000 and by profit and loss account 15,000. So total 20,000, 20,000. So let's prepare cash flow statement. But before we prepare the cash flow statement, we need the value of cash from operation. So net profit 0, because I'm not able to find any net profit. So I'll assume that net profit was 0. And then dividend proposed rupees 15,000. It will be added to the net profit. One thing more, there were debentures. Debenture means long-term loan taken from the public. It's a long-term loan. 10,000, then it was 0. So I will assume that the money was repaid to the debenture holders at the end of the year. But the figure is 10% debentures. What it means? You pay 10% interest on this loan, and the loan is 10,000. It means every year you pay 1,000 as interest. So this company must have paid rupees 1,000 as interest to the debenture holders. And when you pay interest on long-term loans, this is non-operating item. I mean to say non-operating expenditure, which is found on the debit side of profit and loss account. Of course, this is cash transaction, but this is non-operating. You know, when we have to calculate cash from operation, what we do? We add all the non-cash expenses and non-operating expenses to net profit. So this is non-operating expenditure of the company. That is rupees 1,000. So net profit plus interest on debentures 1,000 plus dividend proposed 15,000. Total 16,000. So this is the net profit before the effect of current assets and current liabilities. So at this stage, this net profit is called funds from operation. Now I have to put the effect of current assets and current liabilities. You know, there is only one current asset on the asset side, that is debtors, 5,000, nil. It means there is reduction in the value of debtors, I mean to say current assets. You know, whenever the values decrease, it is added to the net profit. I have already explained you this thing, why it's happening. So what will happen? Add 5,000 to 16,000. That will be 21,000 rupees. So you will write down decrease in debtors, rupees 5,000. So cash from operation is 21,000 rupees. Now we are ready to prepare the cash flow statement. Opening cash 5,000, closing cash 10,000. Look at the balance sheet carefully. Then debtors, we are not concerned. Then furniture. Previously it was 10,000. Now it is 20,000. What it means? There is increase in the value of furniture. It means during this year, the company must have purchased furniture for rupees 10,000. So if the company has purchased the furniture, the company must have paid cash. Then it will be shown on the outflow. Furniture purchased rupees 10,000. Now liability side. Previously capital was 5,000. Now capital is 15,000. There is jump of rupees 10,000 in the capital. What it means? The company has issued shares of rupees 10,000. That's why there is increase in the capital. Be careful. If it's a joint stock company and there is increase in the capital, this increase cannot be due to net profit. It is always due to fresh capital. It means the company has issued shares to the public and the company has collected the money. So 10,000. So issue of shares on inflow side rupees 10,000. Then cash from operation 21,000. On inflow side total 36,000 rupees. Then debentures. Previously it was 10,000. Now it is 0. It means the company has paid back the money to the debenture holders. So debentures paid rupees 10,000. Moreover, the company has paid rupees 1,000 as interest. This transaction is financing transaction and it will be shown on the outflow side. So interest on debentures rupees 1,000. Now proposed dividend. So if you have a look at the proposed dividend account, you will find the company has paid rupees 5,000 as dividend. This is the payment and it will be shown on the outflow side. Dividend paid rupees 5,000. Total 36,000 rupees.